Good morning, everybody. My name is Matthew Mims from the Investment Store, and I'm delighted to welcome you all to this latest investment briefing from Devon, featuring Devon Portfolio Manager Nick Dravitzki. So in today's webinar, Nick will comment on the recent falls in the NZ equity market and discuss his views on the high-yielding Australian NZ equity sector. Please note that this presentation should not be deemed to constitute financial advice or a recommendation to purchase a financial product. The information provided is for discussion purposes only and should not be relied on in making an investment decision. So this session will last for approximately 15 minutes, and we will allow some time at the conclusion for any questions that you may have. And thank you to those people who sent in questions prior. We will endeavour to ask those as we go along or at the end. So without any further ado, I will pass you over to our speaker, Nick Dravitzki.
Thanks, Matt. Good morning, everybody. So it's a very topical subject matter today, and that is the recent weakness in the New Zealand market. I'll just skip over that performance slide and go to slide 3. So yesterday, the New Zealand market officially entered a correction. If you round to one decimal place, it's down 9.98% from its peak on the 7th of September. So we'll call that 10%. Look, it's a decent decline, and as slide 3 shows, it's been much sharper in New Zealand than in other markets around the world. We've got very used to outperformance in the positive sense, and as the year-to-date and longer-term numbers show, even after this period of weakness, we're still ahead of most markets for most of the year, for this year and for the last 3 years. Now these numbers are the NZX index and the ASX 200 in net terms, so they don't include dividends, and that's to make them consistent with the other index numbers from around the world. For New Zealand investors and Australian investors, for investors in those markets, their returns would obviously be higher both in absolute terms but also in relative terms, reflecting the dividend yields, the higher dividend yields of those markets. But if you look at the year-to-date number with New Zealand up 10% and well ahead of other markets, it really shows what an outlier the New Zealand market has been this year-to-date prior to this correction. So what I thought I'd do today is discuss some potential reasons for the sell-off, and then maybe talk about some of the opportunities that it might be presenting. And before I do, let me make the point, as always, that when talking about the reasons for a sell-offs, these are at best qualified guesses. We never know exactly why markets move the way they do, but I will make a few suggestions about some potential good reasons why it may have happened. First of all, we know that there hasn't been a macro shock, in particular in the New Zealand market, and local earnings generally have been improving as the economy has been improving. Now, there's obviously been some exceptions to that rule. In the big caps, you've seen Sky City come out with a very low quality profit warning last week. Yesterday, Comvita had a very significant downgrade, and of course you've had the sad cases in the last few days of both Wynyard and Pumpkin Patch going into receivership. But generally, as the economy has shown reasonable growth and better growth than most economies around the world, you have seen that flow. You've started to see that flow through to company earnings, and there's been reasonable momentum in company earnings. Another thing we know is that offshore participation in the New Zealand market has increased and is up around 50% by value of the New Zealand market, and that's increased from closer to 20-25% a few years ago. So what it looks like is happening at the moment is that some of that offshore money has decided to step out of the New Zealand market and decided to take some New Zealand risk away that it doesn't need to have in those sorts of portfolios. Now, why that may be? Well, it seems plausible that given rising concerns around the Fed lifting interest rates and that translating into higher bond yields around the world, that this part of the world, which is very much seen as a yield market, may be an opportunity, may be seen as a potential place to take some risk off the table. And clearly, those markets that have benefited from the yield trade are those that would most likely be avoided. And in a world where the yield trade as a theme becomes less popular, both the New Zealand currency and the market as a whole, which is well known for its high yield, could seem less attractive to offshore investors. Now, slide 4 just has a look at the top 10 names in the New Zealand market since that peak on the 7th of September 2016. So both these tables, the first column refers to the performance since the peak of the New Zealand market, which was the close of the 7th of September. As you can see there, the selling has been broad and in some ways reasonably indiscriminate. And from the point of view of selling yield, it hasn't shown at an individual stock level. So if you look at some of those names there, Spark, which is very high yielding, is only down 3%, whereas a stock like Ryman Healthcare, which pays a very low yield, Fisher & Paykel Healthcare, which also pays a low yield, and Auckland Airport, which hasn't really been a yield stock for at least a few dollars, are down significantly more than some of the high yielding names. On average, the big caps have been hurt slightly more than the market, and again that would be consistent with some offshore holders just deciding to step away. Now, one of the interesting things is there isn't really any evidence of particular stress in the selling. So daily values, average daily value traded since the 7th of September is very consistent with long-term averages. Typically when you get event-driven sell-offs in equities or news flow that drives equity selling, you see a real spike in liquidity, and we haven't seen that. So it hasn't really been a wall of selling come into the market. It's just been very consistent, regular level of volume, and probably due to valuations and a bit of skepticism around from some local institutions around some of those valuations. Prices have had to come back before they've found some buying. So if the selling has been driven by offshore concerns around interest rates, what is it that's driving that concern? And I think a possible answer is fears around the risk that inflation may be beginning to rear its head, and that's started to be reflected in rising bond yields. So if we look at, I'll just have a number of charts here from the US, analysis on the US, and looking at some of the issues that may be causing this concern around the potential for the Federal Reserve to need to raise rates faster than they have been up until now. On slide 6, it's pretty clear that all measures of inflation in the US are showing upward momentum. Now, the dovish view is that the momentum is slowing, but clearly over the last couple of years, you've seen significant increases and upward momentum in inflation across inflation, however you like to measure it. And what is interesting about that inflation, and New Zealand's a little bit like this, is that services inflation has in fact been reasonably consistent, and where you have seen deflation is in goods, and slide 7 shows that. Slide 8 shows wage growth in the US, and you can see that it's now back to levels that we haven't seen since 2006, and back to the 2006 level. And you would expect that as this flows through to that service side of the economy, it would have an inflationary effect if that continues to rise. And slide 9, just the last slide on that US inflation risk, shows that China is no longer exporting deflation. So, and this is a very important development. So if you go back a number of years, China has factory gate prices in China, the producer price index has been negative, it has been deflationary for a number of years, and that has just recently moved into positive territory. So if you start to see that flowing through to positive inflation in goods, aligning that to positive and increasing inflation in services, then it's not surprising that you're starting to see that momentum come through in headline inflation. Now, if that is the case, and the Fed needs to react quickly, it does seem pretty clear that bond markets at the moment generally are underpricing the risk that the Fed will need to raise more than once in the near future. And if that is the risk that's starting to be seen by markets, then that would explain some of the rising bond yields that you're starting to see, and concerns around the persistency of the yield trade, as it's called. So where does that leave us? I guess I'll turn to valuation now. So the chart on slide 10 shows the New Zealand 5-year government bond yield versus the NZ50 dividend yield. And the striking thing about it is that despite rising bond yields, and partly because of the recent sell-off, the gap between those two is still very large. And this, I think, from a stock picking point of view, is where it gets quite interesting, because there are still a large number of attractive ideas out there that have yields that are very attractive, and will remain so even if rates continue to move materially higher from here. And I've set out a few of those on slide 11. So you have the 50 and the ASX 200 dividend yield from a gross point of view to a New Zealand investor on the left-hand side, and then just a handful of stocks there that continue to look pretty attractive even if we do continue to see rates rising locally. So Meridian and Contact, and you can add the other gentailers to this list, continue to be highly defensive. They have modest growth. You're starting to see a little bit of demand growth coming through in the electricity market, and very attractive yields. Even if 5-year rates rise materially from here, those yields still look pretty good. In the case of Contact, Meridian's yield, they are overpaying from an earnings point of view, but they can continue to do that for a number of years quite safely. Contact is choosing to pay down debt, but generates a very high level of free cash flow. Both businesses have no great need to invest in any new generation for the foreseeable future, and so they are spinning off large amounts of cash, and that flows through to high and growing, in the case of Contact in the future, dividend yields. Spark Infrastructure, so that's a net yield essentially to just the net yield plus a little bit because it's a stapled stock. Australian infrastructure business, electricity distribution business, very attractive yield, growing at 5 to 7% over the next 3 to 4 years, with a regulatory, very benign regulatory outlook, and in fact a reasonable chance of that of winning some hearings that will see that outlook improve even further over the current price period. So attractive in the same way that the New Zealand gentailers are. Horizon has been a defensive play, so all of these stocks have been holdings across a number of our portfolios, all of them in the dividend yield fund, but also across other funds. Horizon has been introduced to the funds in recent months on very attractive valuation grounds. It's a regulated, primarily a regulated utility plus a coal transportation business, and as it's had concerns around its valuation on the basis that coal, although it had many long-standing take-or-pay contracts from its customers, low coal prices were threatening the solvency of some of those customers. That was one of the key issues around the stock. The recent recovery and spike in coal prices has allayed a number of those fears, and valuation looks particularly attractive. And TradeMe, again, good dividend yield with a strong underlying revenue growth, and now that it's got to the end of its necessary investment in people and product, it has an attractive, a conservatively low double-digit earnings growth profile as you look forward into the future. Finally, a stock not shown here, a good example of the types of stock that we are ideally looking for regardless of what happens to bond yields and to markets as a whole, is GTN. And we've talked about GTN before. This is the Australian-based radio advertising traffic network business that has now had a very exciting announcement yesterday that the subsidiary that it's due to acquire in the United States has just signed up a very large customer, and that is likely to have a material impact on earnings. And so, as always, we are looking for stocks where we can find drivers and earnings growth almost regardless of what's happening in the broader macroeconomic picture. Now, there's every chance that if the Fed starts to raise rates more aggressively, or the market starts to believe that will happen, and as I mentioned, given the inflation data that we are starting to see, it does seem that some of those risks are materially underpriced at the moment. Then we may well see more selling and more of that offshore money walking out of the New Zealand market. But if that does happen, that will present significant opportunities to buy good businesses at increasingly attractive prices. The last thing I would say is that rising rates will definitely have an impact on a number of things across the economy and on asset prices generally. And if we see longer dated bond yields rise globally and locally, then I think locally the real risk is our highly indebted household sector and real estate prices in particular. I'll just leave you with one sobering table, which comes from Deutsche Bank and based on OECD data, and that shows relative house price valuations of a number of OECD countries and New Zealand when you combine home prices relative to rents and home prices relative to income is extremely overvalued, and in fact the most overvalued in the world. Our friends in Australia, a very interesting stat that came out last week on the residential apartment boom there. There are more residential apartment cranes up on the east coast of Australia than there are in all of North America at the moment, which would suggest that there may be a significant overbuild happening over there. My point is simply that while rising bond yields will have an impact on markets, it's the broader macroeconomic impact that we perhaps need to be most wary of. So I'll leave it there and happy to take any questions.
Thanks very much, Nick. So we've got one or two questions. The first one really is just some comment on your expectations on earnings growth over the coming period in both New Zealand and Australia.
So looking at New Zealand, as discussed, growth here has been reasonably good, and you've seen consumer spending very much driven by a combination. The most positive drivers for that have been tourism's been exceptionally strong. Migration's obviously driven some of the GDP, and you've seen an increase in consumption, which is obviously closely related to rising house prices. So that has flown through to economic activity, and you can be reasonably optimistic about a number of New Zealand companies posting reasonable earnings growth on that basis. Relative to expectations, that has been priced in the sense that there's no obvious the market is expecting earnings to rise. When you look at consensus forecasts in Australia, you've had several years of consistent downgrades of consensus earnings, and as the years gone on, earnings have continued to be downgraded throughout the year. 17, while it may not necessarily be without downgrades, the recovery in resource prices, coal, iron ore in particular, is very positive for overall earnings, which have been those resource companies have been a real drag on Aussie earnings. So we may well get a period where we don't see those significant consensus downgrades coming through, which can only be positive for the Australian share market as a whole.
Just a question here: Are any companies in New Zealand guilty of ramping up their payout ratio in order to attempt to pander to the market's demands for yield?
There's no question that management have been interested in satisfying investor demand for dividend yield and have looked to, increase payout ratios. So the big banks, obviously two of which are listed on the New Zealand market, have in the past, although some of them have pared it back now, increase their payout ratios to probably unsustainable levels. Meridian, as mentioned before, pays out a higher dividend yield than its earnings can sustain, but it has started from a very low debt position. Spark is similar, so they are paying dividends that the market has liked, but it's not possible for them to pay those indefinitely. In both those companies' cases, there is a reasonable multi-year time frame that they can continue to pay those dividends, and given the relative defensiveness of their earnings, that is a risk that is probably manageable.
Okay, we've probably got time for a couple more questions. There's just a question here around how low or high the prospective yield for the local market could go if you had a rising interest rate environment relative to where it is at the moment.
Yeah, it's a great question. I think if you look at what's happened to bond yields, if you go back to that chart on which showed the dividend yield in the New Zealand market versus the 5-year government bond, you'll see that there have been very material gaps between those two things over time. And in the last couple of years, as bond yields have really been driven lower, you haven't seen that happen so much from the market. The market hasn't followed in lockstep. It's come down a bit, but hasn't fallen that much. And in fact, we are now on a gross basis, we're actually very close to the 5-year average. So while I think rising bond yields are not likely to be a great driver for valuations in the New Zealand, or for value in the New Zealand market, for prices in the New Zealand market, it would seem, there seems to be a reasonable amount of headroom for yields to rise a bit before you would see the headline market yield go up materially. But you never can tell.
Just final question, the dividend yield fund, can you just highlight the current yield that the fund is paying and what's it actually paying out?
So its distribution is 5% per year and four payments. Its current gross dividend yield is 6.2%, I believe.
Okay, all right, so I think we've run out of time. So on that final note, I'll wrap the session up. Just a quick note, thank you to Nick for taking the time to prepare the material today, and also thank you to you all for taking the time to dial in. I hope you found it interesting and also enjoyable. You will receive a follow-up note from us, so we'll send out a copy of the slides and a link to the presentation just in case you want to listen to a playback. But on that note, thanks very much and have a good day.